Okay, so this is a video that I like to make because I talk to a lot of people about the types of mortgages they're getting. We're working with different buyers, and some people choose adjustable rate mortgages and 5-year, 7-year, 10-year ARMs. They do look pretty appealing at certain times. And then obviously versus 30-year fixed mortgages. So this video is just going to be why I chose for myself personally a 30-year fixed mortgage when I bought my home. I bought a condo about 5 years ago and I got a 30-year fixed mortgage, even though I knew most likely that I'm going to sell within 7 years. And so I could have got a much better rate and a much better deal and lower payments by getting a whatever was available at that time, maybe a 7-1 ARM or something like that, which is one of the adjustable rate mortgage options that has a lower interest rate, lower payments. But what happens is it resets after a number of years. In the 7-1 ARM case, it resets in 7 years to whatever the interest rate is at that time. And I believe there's caps on how much it can raise. So the reason why I did a 30-year fix, even though I knew that I would likely be selling before the 7-year mark, is because you actually never know what's going to happen, right? I didn't know if my career would be drastically impacted. I would be have to maybe shift careers. Like, who knows if AI would have come in and completely replaced realtors 3 years after I bought my home, and then I make zero money being a realtor, right? There's just so much unknowns. So I'm personally very conservative with my expenses. I'd like to keep my expenses and my mortgage. If I know that for the next 30 years, it's going to be this amount every month, that gives me the ability to say, okay, worst case scenario, I just need to pay this every month and then I can stay in my home. Rather than having this, well, if there's a worst case scenario and then my mortgage might reset to being significantly more in 7 years, thousands more per month, that would be a scary thing for me to think about. So generally speaking, it might not be the most popular and actually the best financial decision to do a 30-year fixed every time. But for my investment properties, which are mostly 2-unit properties in the Midwest, and my own home in San Mateo County, and then future properties that I buy around the San Francisco Bay Area or other investment properties, I will generally tend to stick to 30-year fixed mortgages. In addition to, I personally have a belief that whenever you can, it's best to keep real estate and not sell it for as long as you possibly can. Now, that's not always the case. Like, for example, if you own an investment property, let's say you bought a home, a single family home, and then you upgraded and bought a bigger home, and now you rented your old home out, and you've had it for 15, 16 years. Well, your cash on equity return, the return that you're making from your property based on the equity, right, is probably very, very low. The idea is that you might be netting something in the range of $20,000, $25,000 per year. And if you sold this home and reinvested it into maybe like an apartment building in the Midwest or something else with a higher return, you might be able to double or triple that and make closer to $40,000, $50,000, $60,000 a year. If that's the case, if an opportunity like that existed, then it's kind of a no-brainer to sell your property, do a 1031 exchange where you can defer capital gains taxes, and then buy a replacement property. Aside from that happening, you might get to the point where, hey, you don't want to do all this activity. And that's why I generally believe in keeping 30-year fixed mortgages, because then it's fixed every month for the next 30 years. Then my property is paid off and I'm good to go. Thanks again for watching this video.